Hello, good evening. Firstly, apologies for the delay. I know that I'm a bit late. It's due to my friends at the KSEB, but nevertheless, let's get started. So, today I wanted to talk about how you invest. Now, previously, in the last session, I asked you to check your bank statement. It was the end of the year, and I asked you to review if you have received any interest on your bank account. Are you aware of what money had come into your account in the month of March? What money had left your account in the month of March? So today we'll go one step further and we will talk about different ways that you could invest, how your money can help you earn an additional stream of income, and we will touch upon some facts of passive income. So, does that sound good? Let's get started. Before I get into it, can you confirm that I'm audible? Can you hear me clearly? Can I get a yes in the chat box? Am I audible? Yes. Okay. Thank you so much. Okay. So today we'll get started by telling you what are the 5 ways that people invest. Now, today we've got different ways in which you can invest in the stock market. One is you can invest in a post office fund. You can invest in a bank FD. You can invest in the stock market. You can invest in a mutual fund. You can invest in a bank fund, that is a corporate fund. A corporate FD is what they call it. Or you could invest in gold and real estate. Now, which one would be the best option for you to invest in? Have you tried investing in any of these options, and which one would be the best? So to start with, let's talk about the post office schemes that we have here. Now, post office schemes previously used to give you an interest rate of about 8 to 9%, but now that has also been revised from this financial year, and we are looking at somewhere between 5 to 7%, depending on your location and which post office scheme you've invested in. If you try investing in the banks, previously the bank FDs used to give you about 6 to 8%. But when I checked today, the interest rates have been revised end of March last year. So from this financial year, interest rates have come down, and the interest on a bank FD is only between 2 to 5.4%. So depending on which bank your FDs are in, you're looking at FY21 giving you a return of anywhere between 2 to 5%. Generally, the banks would try and keep it at least 5.4, 5.5%. So the interest rates have come down, but what you need to understand is with the bank interest, now if you have 1 lakh rupees, you keep it in a bank for 1 year, you will get 5% of that. So you'll get 1,05,000 rupees as interest. But what happens is in the same year, inflation it is at a rate of 7%. So if you have to buy something, that additional 5,000 is not enough. You need to make at least an additional 7%, which means an additional 7,000 rupees on this 1 lakh rupees. So if your expenses are growing at a rate of 7,000 rupees and your income is only growing to give you 5,000 rupees, then there is a gap of 2,000 rupees which you would need to fill. This is just an example for you to understand where your rate of income is coming in and where the rate of expense would be going. So when you have an expense of rupees 7,000 and your income is only rupees 5,000, that's what you would understand. Now, if you save 1 lakh rupees in a bank FD, which would give you 5% interest, you're looking at 1,05,000. But your expense next year might be 1,07,000 for the same 1 lakh rupees. So there is a gap in the interest rate as well as inflation. So that you need to understand that your bank FD is not necessarily going to help you beat inflation. So what is the next option that you can look for? You can look at investing in a mutual fund. You can take the same 1 lakh rupees, instead of putting it in a bank FD, you take this 1 lakh, you put it into any good mutual fund. You can invest in a growth mutual fund or dividend yielding mutual fund or a growth. I would prefer, if it was me personally, I would prefer investing in a growth based mutual fund where the dividend is reinvested directly. It is not paid out. What happens when the dividends are paid out is tax is cut. So supposing if you have again a 1 lakh deposit, you're earning about 12% returns on the mutual fund. If they declare a dividend of say 10 rupees, example, if they declare a dividend of 10 rupees per unit, when they pay out this 10 rupees, you will have to pay interest on that. So maybe you will get only 9 rupees. But if this 10 rupees is reinvested, like if it is a growth fund, it is reinvested. They don't pay you out. So instead of that, you receiving 9 rupees, paying the government 1 rupee, you will receive the whole 10 rupees back into your investment. So which means in the next year, 1 lakh and your growth rate of 10 rupees per unit. So say 1,10,000 which you receive will grow at that rate instead of 1,09,000 growing if you had to take the dividend payout. So that's the difference between a growth-based mutual fund and a dividend-based mutual funds. But that's not just the typical example. There are some mutual funds in which it might not grow at 10% rate, but the dividend might be yielded much higher. For example, you might have invested 1 lakh rupees. You might have had a growth of only about 6% or maybe 7%. So maybe at the end of the year, your investment has become 1,07,000, but they would have given you 3,000 as dividend. So in that case, the tax might be a smaller amount that is cut off compared to the amount that you would earn as dividend. So you need to understand whether it's a dividend yielding or a growth yielding mutual fund. Then we have the stock market, which is equity shares which you can invest in the NSE or in the BSE. We'll leave stock market here on pause for now because that's a vast topic, and we'll go into the next one. The next one is real estate. Now, real estate is something you can buy land, or you can buy a flat, or you can buy ready-made property. Now, that requires a lot of lump sum investment. No doubt land will appreciate, but we need to know if it will appreciate enough for you to beat inflation. And also, how many of us are going to go around every day and buy a plot of land or buy property? So it may not be the actual avenue for a first-time investor to just start buying real estate. If you have the money, like if you have 10 or 20 lakhs kept aside for investment, then yes. But if you are just a mom starting out, you want to do some small investments for your family, then real estate may not be the avenue for you to enter in as an investment. You might have to buy a house, yes, that is for you to stay in, but it may not necessarily be an investment decision. So if you are looking to invest in real estate, you need to have a financial backing. So that also may not be an avenue for somebody to just start out. Then we have corporate FDs. Corporate FDs are basically, instead of you putting money in a bank FD, where the bank gives you interest, you put money in a company's FD. Now, what is the difference between a bank FD and a company FD? A bank FD might give you a certain fixed amount of interest, but same way, just like how a bank gives you interest for your investment, a company will also give you interest for your investment. If you haven't heard about it, there are some companies like Mahindra Finance, ICICI Home Finance, Shriram Transport. Like these companies actually ask the public for money, and they use that money to run their processes. And in turn, they will give you a better rate of interest than what you would get in a bank FD. But the risk involved in this is that the company could go bankrupt, and in that case, you may not get your returns back. But if it is a good, well-trusted company approved by the credit ratings, then the risk might be minimal. So now we go back to the one big point that I kept on pause, the equity market. Now, how do you invest in the equity market? What is the equity market? You all have heard about stock market. You all have heard bits and pieces here and there. But do you really understand what happens in the stock market? So today I'm going to it is 4:32 now. I would try and explain in at least 15 minutes just to give you a basic understanding of what is the stock market. So now the Indian stock market is actually, there are various stock markets. The main two markets are the NSE and the BSE. The NSE is the National Stock Exchange and the BSE is the Bombay Stock Exchange. So every day, now supposing if you switch on the TV, you look at CNBC or you look at any TV 24/7, you would see the stock rates going down on the screen. And on the side, you will see NSE, BSE, and you will see the rates. Now, what is this? How do you understand what are those numbers, or what's the ticker, and what is NSE and BSE? Now, the National Stock Exchange is a stock market. It's basically a market where companies' shares are traded. Now, in the NSE, we have something known as Nifty 50. So when you see on the side of the screen, you would see Nifty written and you would see a number. Now, what does this Nifty mean? Now, the Nifty consists of 50 top stocks on the NSE. So I'll come again. Now, in the National Stock Exchange, there are maybe hundreds of companies that have registered. So it's a big exchange. These companies have registered themselves on the National Stock Exchange, and they are ready to be traded with each other. Now, when us, that is retail investors, we can buy and sell any share that is listed on the National Stock Exchange. So now, how would you choose what is the rate, how many companies are there? So in order to get a benchmark, the regulators or the rating agencies have selected the top 50 companies, and those 50 companies are listed in the component called the Nifty 50. Now, in this Nifty 50, the top 50 companies' share prices are taken, and that average rate of those prices is what they would mention as the Nifty growth. So if they say Nifty is up 100 rupees, it means that all the 50 shares that are trading on the NSE selected in the Nifty, those have moved up 100 points or moved down 100 points. So it takes a cumulative average, and those 50 shares are represented in the Nifty rating. So now what about the Bombay Stock Exchange? How would you know? Now in the Bombay Stock Exchange, we have the Sensex. Now the Sensex consists of 50 companies. Okay? Sorry, the Sensex consists of the companies in the BSE stock exchange, and those companies are shortlisted and kept as the benchmark for the BSE. So in the BSE, we have the Sensex, and in the NSE, we have the Nifty. Now, how do you buy and sell shares? How does this work? So in order to start buying and selling shares, there are two ways you can do it. One, you can take the decision of which share to buy, which share to sell. How do you go about it? Or two, you can buy a mutual fund which invests in the stock market. So if you're a first-time investor, a first-time trader, you're not really sure about how it goes, I would advise you go for a mutual fund. Don't start off directly in equity, because you don't have the knowledge to buy and sell shares on the stock market. So in that case, for somebody who does not know anything about financial investing, it is best to start out with a mutual fund. Now, if you already have been investing in mutual funds for the last 2-3 years, you've been working for a few years, you would like to try to make your own investment decisions and invest in the stock market, then you would go ahead and open what is known as a demat account. Now, what is a demat account? A demat is a dematerial account. What does that mean? Now, previously, when you buy a share in a company, you would receive something known as a share certificate. So that is a physical certificate that says that you are the owner of this many shares of that company. You would take this physical certificate and go to the stock exchange near you. Now, if you are living in Kerala, you may go to a stock exchange called the Cochin Stock Exchange with these physical papers. And there you will trade these papers with somebody else who also has a physical copy. Now, this used to happen way back before the IT boom and before 2000s. So in that era, we had hard copy shares being traded in the market. But now, we don't use this paper hard copy. We are not going physically. We are doing everything online. It is electronic, which is good news for us women, which is because you can sit in the comfort of your home and do the same thing. So now, in order to trade, if you buy stock from a company, they will not send you a physical share certificate, but they will put your shares into your demat account. Now, a demat account is an electronic account. You will open it with a broking house. Who is a broking house? A broking house is someone who NSE will say, okay, you can be a broker. Now, this broker will trade on your behalf. So they will give you an account. Basically, it's like if you want to open a bank account, you have to go to a bank. So same way, if you want to trade, you have to go to a broker. So the broker in this case will be any broker that is registered on the stock market. Make sure that you check. There are a lot of scams going around where people will say, okay, you can trade with me. People have transferred money. So be very aware that you cross-check who is the broker that you are dealing with. So your broker should be a broker who is registered and legally in good standing. Okay, so you need to know who you are giving your money to when you open your demat account. So once you open a demat account, you have purchased some shares in the electronic form. That is, the demat account, they'll give you a software. You can go into that software, select a buy. You can buy a certain share. and it will reflect in your demat account. When does it reflect? Does it reflect immediately? No. If you're buying shares for delivery means for investment where you are keeping, you're not trading it on the same day. I would advise you initially go as an investor. There's a lot of difference between an investor and a trader. We'll go into that mindset later. But now I will teach you how to be a good investor. So you go into the stock market, you open your demat account, and you select to buy a certain share. Now, the government, or SEBI rather, SEBI is a regulatory body. So SEBI has said that shares bought in cash will reflect in the account as T plus 2. What does this T plus 2 mean? T plus 2 means today if I'm trading, today I'm buying that share. Let's say, for example, today I buy 10 HDFC shares. So today is my trading date. Today's date is the 12th of April. Okay. So on 12th of April, I have bought 10 HDFC shares. Today is a Monday. It's a working day. So when will it show in my account? Tuesday will be T plus 1. T plus 2 will be Wednesday. So those shares will come into my demat account only on Wednesday. So between that, tomorrow on Tuesday, I will not be able to sell that share. I have to wait until that reflects into my bank account. And on the fourth day or third day, you can sell once it is reflecting. So when you buy a share, it will take T plus 2 days, and then the share will come into your demat account. So that is the basic. So you will buy shares and you will hold it. Now, supposing if you buy at 100 rupees, it goes up to 105, 110, you will sell it at a profit. So that is the basic of how the stock market works. Now, how do you know who will buy from you, who will sell? How do you buy and sell? Now, what happens is, now if I am interested in buying a certain share, I will enter, Jasmine, I'll enter my trading code, and then I'll enter buy 10 shares of whichever company. Say if I'm buying ICICI, I'll say, okay, buy ICICI 10 shares. Now, if I enter that I want to buy it at the rate of 100 rupees, this is just for example, it's not the trading rate today. If I want to buy it 100 rupees, and there is somebody else sitting in Mumbai who also says, okay, I have 10 shares of ICICI, which I would like to sell for 100 rupees. So the computer, that is a system in which we are all trading, the system would recognize there is a buyer who wants to buy 10 shares for 100 rupees, and there is a seller who wants to sell shares for 100 rupees. And the system will match the trade. So that is how the trades take place. But the advantage for women in this case is the stock market does not know who is buying and who is selling. It doesn't matter. If there is a buy option available, buy 100 at this price and sell 100 at this price, and if the prices match, the sale will take place. So you don't have to be afraid that, oh, I'm a woman, how will I be accepted in the stock market? There is nothing like that. That is just a mental block. The stock market does not differentiate between gender. The stock market doesn't differentiate whether you have 10 years experience or if you're first day in the stock market. If there is a trade that you have executed to buy something, and if there's the same trade that somebody else has executed to sell, if the trades match, the trade will take place. So that is the basics of how the stock market functions. So what have we learned so far? We've learned that to trade in the stock market, you need a demat account. You need to have some credit, that is some balance in your account to be able to buy and sell shares. And once you buy and sell a share, it will show up in your demat account as T plus 2, that is trading day plus 2 days. So we know, and you can sell the shares only after it reflects in your demat account. So that is the first step that I want you all to learn today. Open a demat account, transfer your money. Once you transfer how much you want to invest, then you buy and sell. And the buy and sell will happen when two trades execute. Okay, so that is just a simple example of how to buy and sell. Now, what is the Nifty? We learned Nifty is the top 50 shares listed on the NSE, and we also have the Sensex, which reflects for the BSE. Okay, so I hope that this much is clear for today. Now, how do you decide how much should I invest? Now, how much each person should invest is their own personal decision. Whether you want to start investing every month 5,000, every month 10,000, then you can go into a fixed mutual fund or an SIP, which is regularly debiting 5,000 or 10,000 depending on your saving capacity. Now, over and above this, if you want to save in the stock market and you want to enter into investing on the long run, then you will keep aside a certain amount of money which you are willing to take the decision for yourself. It's not being managed by a fund manager, it's being managed yourself. So then you will do the research. I will teach you as we go along further in these live sessions. I'll teach you how to research your company, how to understand the fundamentals and the technicals of the company. So once you have shortlisted which company you would like to select, make a small portfolio. How do you make a portfolio? Select, say, maybe out of all the hundreds of companies that you see, you select 5 companies that you think are doing well. If you don't know how to select, the easiest would be pick 5 companies already listed in the Nifty. Now, they made it to the Nifty only because they met certain criteria listed by the rating agencies. Only if they're AAA rated will they make it to the Nifty. So, if you don't have the capability of understanding which shares to select, just select any 5 shares from the Nifty and look at investing in those 5 shares for the first 6 months. So that way you will get a hang of trading, you will get a hang of how this execution works, how shares come into your demat account, how when you make a sale, how it is debited from your demat account. You'll have a general idea of how trades match. So in the next session, I'll wrap up for today. I just wanted to introduce the basic concept of what is the stock market, how do you invest in the stock market. If you are a first time investor, I will advise you not to go directly into the stock market, but to go into a mutual fund instead. If you would like to know more about what is the difference between stock markets, what kind of mutual funds are there, then do let me know in the comments below. I'm doing this session only to educate women. I want more women to come out and step out, start making income online, start learning how to trade, how to take control of your finances. So if you have any question, do post it in the comments below. I'll do a next live session next Monday. Hopefully, I can make it at the same time. So I hope this session was helpful for you. Thank you so much for logging in, and I'll see you next Monday. Do subscribe to this channel if you would like me to do more videos based on personal finance. And I'll see you next time. Thank you for coming. Bye.